Crown Money, where we show you how to pay your home loan off in up to half the time of a normal bank loan. Welcome to the Crown Money podcast. I'm Jessie and I'm joined by Scott Parry. What's up?
What's down?
Look, I really want to have this conversation. I think lately we've been talking a lot about different types of investments. We've been talking about debt recycling. We've been talking about our passive income plan, which is really awesome. But I just want to take it back to the foundations and make sure everybody understands what we're talking about when we talk about the different types of investments that you can be utilizing. So this is us going back to basics, baby. So I would love to know, Scott Parry, what are the different, I'll go through what the different types of investments are, and if you can spell it out for us and talk to me like I have no investment background at all, I think that would be very beneficial for those people that possibly want to ask what things are or don't want to admit that they don't know what they are. They feel like they should know what they are, but they don't fully understand it. That's what this session is about.
And this is not financial advice.
Yes.
Literally educational.
I'm going to have a button that I can play that just has that recorded, and we can just go, boop, that's not financial advice. Yeah, look, this is general advice. You would need to speak to a financial planner for advice specific to your situation. Cool. All right. Scott, what is a share?
Share is a company that you own a piece of. And so there are only a few ways to make a lot of money, and one of those ways is to be an owner and an owner of a company. And so if and when you are looking to buy a share of the ownership in that company, you then go onto the ASX or the S&P 500, all these different exchanges where these companies have listed their stocks to be made available for sale. Really good because it's very liquid, so you can get in and out very quickly. Some people trade shares for days. Some people just buy and hold, everything in between. So shares are ownership in that company that you believe in. It's obviously got ticks in all the right boxes. It's got a moat. It's different. It's unique. I love the concept. My mum does this. Of only investing in shares that she uses those companies' products already. And so she has an Apple phone, she does that. She uses Facebook, she does that. She flies Qantas, she does that. She drinks a ton of Coke. She does. I think it's like 4+ cans a day minimum. Like it's
impressive. Like that's an effort.
It is like water is losing the battle to go. So she just says that these are companies that I believe in. I like their products, and so why don't I want to own a piece of the company that I'm reusing? And so every time she's drinking a Coke, she goes, "Man, I'm supporting the company, helping the people."
I love it. Okay, awesome. So share is a small portion of ownership over one specific company.
Yes.
Cool. So extending from that, what is an ETF?
So an exchange-traded fund is a group of companies on a stock market. For example, the Australian stock market, it's the ASX 200. That means the top 200 companies in Australia. And so those are companies like BHP, Rio Tinto, Woodside, CBA, ANZ, Macquarie, etc. All the banks, all the mining companies, the Woolworths of the world, the Bunnings, the top 200 companies in Australia, you get the basket of those companies. So you don't just put the money into that one company, you own the entire 200. And so that for a lot of people, all your super funds are running with ETFs. And so their index funds is another word for them, where they just track the index, that not specifically one share. So the risk is a lot lower. You're not going to just buy one share and that company goes out of business. It's basically impossible for you to lose all your money when you're running with an ETF. And so they're very cheap, very good value. And for a lot of investors doing the set and forget strategy, that's definitely the way that they play it. They just, because your super is doing exactly the same, right? Like just dollar cost averaging, you're putting $1 billion each and every month or pay, whatever it may be. And then that's just continually growing over the course of time. So index funds, ETFs, are just a basket of the top 200 companies in Australia or the top 500 companies in America, like Tesla, Meta, Google, like these huge companies.
Yeah,
so
the big dogs. We like
the big dogs. Yeah, they're the best companies in that country.
And kind of one of the benefits of an ETF over a share potentially is that, and we say this all the time with investing, you want to be diversified. I think, like you've said it before, where, unless you are a specialist in a particular asset class and you understand it inside out, your investments should be diversified. You need to be spread across some different types of investments so you're not overexposed to one. So, for example, if a client has nothing but investment properties, like if something in one suburb, then if something were to happen in that suburb, all of your investments go down. Whereas if you have one investment property in one suburb, one in another, and some shares and an ETF, you've got your risk spread over some different classes. So, cool. ETF. All right. Now, what is the difference between an ETF and a managed fund?
Great question. So, managed funds have an investment manager sitting over the top of that pool of money, and that investment manager say, hey, I think we're going to get some really good growth over in that sector or that investment class. Oh, I think we're going to get some really good growth over there. And so every investment manager has a different model of the world or a different perspective as to where they think the best growth is going to be. Fascinating enough, all the studies coming back, Tony Robbins did a study on this saying that ETFs, index funds, outperform managed funds like 90+% of the time. And so you're paying for this manager, you're paying an extra, it's a lot more expensive than index fund or ETF. So you're paying a premium for this manager who's telling you that they know what they're doing, but 90% of the time they don't beat the index fund, the set and forget, super cheap, low cost option.
That's easy, isn't it? That's so funny to think about. Like, this is their full-time job and they're still not doing better. Yeah, one job. So with a managed fund, it's important to know that the managers may invest in shares, they may invest in ETFs, they may invest in property trusts, like whatever it may be across the different asset classes, and they'll just change the amount that they're invested in each type, depending on what they think is going to happen in that particular investment cycle. Cool, managed fund. All right, next is property.
So Australia loves property.
Loves an investment property. Loves it.
I mean, for all the right reasons, like it's leveraged. And what I mean by that is, like, if you have $200,000 and you put that into the share market and it does 10%, you've made 20 grand. Congratulations. You put that same 200 grand into an investment property as a deposit and you get an $800,000 property. Well, now that suburb does 10%, you've made 80 grand. Same $200,000 investment. One made 20 grand in shares. The other one made 80 grand because you leveraged it. And so leverage is good over a long period of time. Not so great if you're trying to do an in and out sort of job. So with property, there's two primary types of property. There's commercial property and residential property. So everyone knows residential properties, places where people live. There's positive cash flow properties where the income covers the rent. And then there's also negatively geared properties where the income doesn't cover the mortgage. And so you've got to chip in every single week to top it up. Primarily, the positive cash flow properties don't generate as much growth traditionally as what a negatively geared property does. But on the other sort of side, you can actually manufacture equity with those residential properties, buy a bigger block of land, put a granny flat on it, and then that means you got two rents from the same piece of land. So you can actually increase the cash flow on that traditionally negatively geared property. So that's residential property. There's obviously some talk of capital gains tax and what that's going to do, because if you hold the property for more than a year and you sell it, then 50% of the profit you get a discount on, so you only get taxed on 50% of the profits, which is very attractive, and they let you claim all the interest and depreciation bits and pieces. That may change. The other one is commercial properties. Commercial properties are really good for people who want higher income, high yield, and so the yield on a commercial property or the income off a commercial property is closer to sometimes 8%, sometimes even up to 10%, whereas a residential property could be like 3.5% to 4%. So the cash flow is really good on a commercial. However, you've got longer vacancy periods. If the tenant leaves and they're a shop, for example, it takes months to find a new shop that wants to take that tenancy. So like anything, the higher the reward, the higher the risk.
Risk, absolutely.
And so commercial property is really good if you've already got a few residential investment properties. It's nice to move. Like, we have a lot of clients who buy one or two residential properties and they'll move to commercial just to bring that cash flow up, which balances out the negative gear on the residential properties. So yeah, there's no right or wrong. They're both great as long as you've got land component. Obviously, that's the key part of any growth. So
commercial properties, you do have to have a bit of a stronger understanding around them. I think you need to understand the local area, the demand for that sort of business. Like, there's more to it, whereas residential is a little bit more kind of.
And the other thing which a lot of people don't know is with a commercial property, the tenant pays the rates all the outgoings, bills, the works. Whereas obviously you buy a residential property, you've got to pay your land rate still. You've got to pay all these bills that are associated with the property. So with the commercial properties, like literally the tenant's paying for everything and you're getting a high yield. But obviously the lending environment's not as generous.
No, you can't usually borrow as much to purchase a commercial property. There's potentially, if you want to sell it, there's higher kind of resale timelines.
Yeah, so it's slower. It's a slower moving beast. There's not as many people buying commercial as what there are buying residential. So these are the pros and cons. But yeah, regardless, I think there's definitely an argument for both of those types of property in any portfolio.
Absolutely. Can I just jump back to residential properties? I just wanted to mention something that when you first buy a residential investment property, most of the time it will be negatively geared. So you're going to have to chip in, $200 to $300 a week, depending on the size of the property. But it's important to know that if you buy in the right location, that property is going to start going up in value nicely over the next couple of years. As the value goes up, so does the rent. So just because it starts negatively geared, if you hold it long enough, it will actually end up turning into cash flow neutral, so it's paying for itself, or cash flow positive, where it's paying you. So just keep that in mind that, often when you buy an investment property, the longer you hold it, you're going to turn that around into an income source.
Yeah, what you just said there is the most important part of this entire conversation. The longer you hold it, the sexier it gets. And so let's just
I love the paraphrase. That's great.
It's quite opposite to us humans.
Yeah.
So with a property, let's say, I'll just keep my figures around. Let's say you buy a $500,000 investment property, and you obviously looking at that and you get 10% growth in that suburb in the first year you bought it. Amazing. Well done. You've made 50 grand. You fast forward 10 years. Let's pretend that property is worth $1 million. If that suburb does 10% capital growth in that 10th year, you've made 100 grand because you're getting 10% on that new asset value. And so that's in the first 10 years. Rents are increasing each year, as you mentioned. You fast forward another 10 years. So now we're in the 20-year mark. This is when it gets really nice. You've got positive cash flow. The rent's definitely covering the mortgage by the 20-year mark. The property now may be worth 1.5, 1.7 million. Let's call it 1.7 for round figures. That suburb in that 20th year does 10% growth. You've made $170,000 in 1 year. And it's positive cash flow. And so, like, you're selling a property. If you're buying an investment property, I'm a huge believer. If you're not holding it for at least 10 years, you're just not going to get the juice is not worth the squeeze. But a lot of people sort of tap out at the 10-year mark. I'm like, hold it for 20 and see what happens. We run all these projections for our clients. We run all the numbers to show them what this looks like. And the difference between selling it 5 years and 10 years is okay, but selling it at 15 years compared to 10 years is massive difference. And then selling at 20-year mark, I'm a big believer in setting your kids up. And so keeping the property so that when the day comes and you pass away, the kids inherit a debt-free home and an investment property that you bought 20, 40 years ago. Imagine your mum or dad giving you a property they bought 20 or 40 years ago. You're like, you're the smartest mum and dad I've ever met.
Yep, absolutely.
So the buy and hold strategy.
Yeah, because a lot of people think, how are our kids going to be able to afford their homes and things like that? It's like, you don't have to buy the home they're going to live in, but if you buy them an investment property and hold on to that, and then just like that income stream, that capital growth, tapping into that equity, selling it if they need to, whatever you need to do, like that can set them up for their future. Absolutely.
And it can set you up for your future. Like that property, if you get, let's say, 20 years away from retirement, it's going to be positive cash flow. You retire, the property's paying you to own it. How long would you keep a property that is paying you to own it?
Yeah.
Forever. Like, why would you sell that? It's the dream, being paid to own property. And so I think a lot of people tap out too early. And so traditional property cycles, property goes up for 3 years, down for 2, and sideways for 5. And so during those 5 years where it's, oh, Jesus, this is biting, it's not growing, you're starting to get a bit dejected, the bills keep coming in for the rates, insurances, you got to say, like, I'm buying this for my kids. That's the mindset you need to have. I'm buying this for my kids. Yeah, it's going to help me, obviously, today with tax and bits and pieces with deductions on interest. Then it's going to help me in retirement because it's going to be positive cash flow, fund a little bit of a passive income to supplement my super. But my kids are going to inherit it, and it's going to be the ultimate leg up for them. You cannot set your kids up any better than giving them an investment property in a debt-free house.
And I love the idea of an investment where it is forced savings. And that's what an investment property is. That shortfall in cash flow that you have to stuff up, it's forced savings. Like, you know, you're getting it back, often tenfold with the returns on the property. So like it's you're going to get the return, but it forces you every week. I need to chip in that $200 for the next couple of years. And you just do it. You've automated that then. So yeah, I really like that as well. Cool. All right. So that's property. We love property. It's fantastic. Great Australian dream. Love it. All right. Talk to me about, what is a bond?
Oh, Jesus.
James Bond.
James Bond. It's not a clothing brand. So bonds are similar to term deposits, where you're sort of putting the money in for a fixed amount of time and getting a fixed amount of return. Now, they're different.
Not sexy.
Yeah, it's not sexy. There are corporate bonds. There's different sorts of bonds. There's investment bonds, but primarily it's a set amount of money in an account for a set period of time to get a set return on that investment. And that means that the money's locked away, similar to what a term deposit traditionally is. And so
the only thing that's sexy about it is that it is low risk.
that's why it's low return.
Yeah. Yeah.
Low return, low risk. It's really what a lot of retirees love the concept of, because, hey, I don't want to have any exposure to stuff that can drop drastically. Obviously, everything goes up and down, but like, it's a lot less volatile than traditionally a share or an index fund or whatever it may be. So, yeah, bonds, similar to term deposits, very low risk, set and forget, low return, but as I said, you got the peace of mind. That's what it's giving.
Yeah. Awesome. Okay, that's great. Last one we wanted to touch on was crypto. Oh, my dog's just kicking that one. Does not like crypto.
Big Bitcoin fan. Wow. So crypto is an interesting one. Obviously, it's just numbers on a screen. There's nothing tangible about it, per se. And so
it's money in general, let's be honest.
Yeah, it's true. I think it's good for a gamble, if we want to put it that way. And what I mean by that is, if you've got $100 to invest, maybe $5 could be going into crypto, 10 if you're a little bit of a punter. But it's something where I wouldn't be putting the entire savings that you've got for your life into crypto. Bitcoin, for example, was very volatile. It goes up very quickly, it goes down very quickly, but it's controlled by the puppeteers who, like, you've got groups like BlackRock who own insane amounts of Bitcoin. If they decide that, hey, we want to move the price down, well, guess what? The price is going to go down. They want to move the price up, it's going to go up. So I think from that perspective, it's definitely like that digital gold, where you're investing in gold, it's there, it's that physical bar, and it's a store of wealth, especially in times of economic uncertainty. People go to safety. It's sort of seen as a flight to safety, gold and silver, whereas Bitcoin is sort of like that digital version of it, and certainly it's worth looking at, but don't bet the house on it. It's something where it should be a part of your portfolio. If you're appealing around about the 5 to 10% mark is what most advisors think it's.
Yeah. I think it's just incredibly volatile. So you can get lucky and you can happen to buy it on a like when it's just sunk down to its lowest, and you go, bang, this is amazing. But just be prepared that overnight it can go back down again. It's just simple.
Yeah, and like anything, if you're sort of looking at it over it, so for example, I dollar cost average into gold, silver, and Bitcoin for my kids, and so every week I put a set amount of money into those three asset classes through the Bamboo app, and so it's just something where it's automated, it's dollar cost averaging. I don't care what the price is every day, because I'm putting the same amount of money in every single week, and so because I'm dollar cost averaging, I actually get the average of that price over that 10, 15, 20 years, however long that investment runs for. So it is something where I do believe in gold. I do believe in digital gold, but I certainly don't think it's going to be changing your life and paying your house off overnight. But like I said, for a kid who's 5 or 6 and you start investing in that for your kid, and then they get to 21 or 30 and like, oh man, you've been investing in this since the age of 6, I think it's going to be a pretty happy story. But we don't know, and like anything, everything has its phase, right? Like fiat currency, like even every currency sort of comes to a crashing halt at some stage over time and over history. All the currencies have gone. So yeah, we'll wait and see how that all lands. But I think it's definitely worth looking at, but certainly just playing with it, not actually being like we've had some clients who've like, oh, I want to basically max out my entire equity in my home and put it all in. And if they did it at the right time, they would be looked at as a genius to do that. Like if you did that a month ago, 2 months ago, you're like, oh, Jesus, that's concerning.
Yeah. Yes.
So they're long-term holders. I mean, we've got a lot of friends and clients who've got good, substantial crypto portfolios, but like it's something where it shouldn't be your core strategy.
Yeah, absolutely. And I think that, you know, that goes to everything that we've kind of gone through today. Those are all the different types of investment classes. It's like, just don't bet the house on one. Like, if you do super conservative, you missed out on a lot of that, you know, the potential. Like, and then the other side, don't go super risky because you've exposed yourself to all of that downside.
Yeah, especially if you're debt recycling. Like, let's just take the numbers back. If you are debt recycling, what does that mean? That means you're paying your home loan down by $30,000 in a year, but then you're redrawing that $30,000 that you've paid off your home and investing that money and obviously creating an investment split. And that $30,000 is now tax deductible because it's being used for business or investment purposes. But you're paying interest on that. And if you're paying interest at 5-6%, you need that return, that whether it be all those things that we just mentioned, to be north of 5 or 6% for you to be making money.
Yeah, it needs to be net of tax.
Yeah. And so it's something where it's not like obviously if you've just got cash around, then you shouldn't be investing the cash. You should be paying the cash off your home loan and then redrawing that and gearing that to then invest. So that's what debt recycling is. You need to be conscious of that. You're already paying 5-6%. So that's your cost base. You need to be getting a greater than 5-6% return for you to feel like this exercise has been worth it.
Awesome. Cool. All right. I think that's really, really great. I think that really covers off on, you know, everything today. We appreciate your wisdom. Thank you, guys.
No, these are just, I said, I'm no expert. It's not financial advice. I'm just telling you over 25 years of experience, what I've come across out there in the trenches, what has worked for people, what hasn't worked for people. But yeah, we just think that just by putting money into different sort of buckets over time, consistently, dollar cost averaging in, like that's the strategy. Like don't try and pick the tops. Don't try and pick the bottoms. That's gambling. Just every single week, putting a set amount of money into a set basket of investments, like your super fund does. And that's why your super fund's doing phenomenally well, is because you can't touch it and you've been dollar cost averaging into it. It's just that's it. That model has worked. Look at your super fund. Look at what it was 5 years ago, 10 years ago. It's like, okay, that model applied to your life outside of super.
Yeah.
Easy.
Love it. Thank you.
Ciao.